In Chapter 13, we'll be discussing at-risk and passive activity loss rules, as well as the individual alternative minimum tax. This is arguably the most challenging chapter in the text, and therefore I provided another assignment template in Blackboard in the event you'd like to use it to check your figures. So let's begin our conversation then about some of these more advanced accounting tax topics. First thing we're going to discuss is the at-risk rules, and this really is kind of the skin in the game, if you will, that you have in any investment, for example in real estate or in a limited partnership. The initial amount then that you have at risk is the amount of cash or property you've contributed to the investment. Things that increase this at-risk amount can be cash or property distributions, your share of the liabilities of the company. So if you assume liabilities for this company, you are increasing your at-risk amount. And then any income or gains you're being taxed on, that increases your at-risk amount. And then any distributions you receive, be it cash or property, that's in a sense a liquidation of part of your ownership interest, and that would reduce your at-risk amount. And so too would the release of liabilities decrease your at-risk amount. So liabilities then can affect these at-risk amount, and one of those kinds of liabilities is classified as recourse debt, and these are debts for which the taxpayer is personally liable. And since they're personally liable, this increases the at-risk amount. Non-recourse debt is kind of the opposite. This is debt for which no individual has personal liability, and therefore this does not increase the at-risk amount. Then there's this third one, the exceptional one really. It's qualified non-recourse debt, and this relates to real estate investments. And this, as I said, is debt that applies to taxpayers involved in the activity of holding real property. Taxpayers are considered to be at risk for their share of such amounts if the debt meets the following criteria, and these are listed in the text as well. If the taxpayer borrowed the money with respect to this investment in real estate, they borrowed from a qualified person or government, no person is personally liable for repayment. Very likely you'd see this in like a collateralized mortgage loan. And then finally, the debt is not convertible debt. If all of these conditions are met, then qualified non-recourse debt does increase the at-risk amount. And again, just to give a little context to this, this at-risk amount is important because it helps the taxpayer to determine how much of any losses of the business that they're invested in they can take on their tax return as a deduction. In the event they don't have enough at-risk and the loss of the investment is greater in any given year than their at-risk amount, then these losses can be carried over indefinitely. And then later you can deduct or apply these the future losses against any increase in at-risk that you may have by making, for example, additional contributions. Losses are still subject to the second test, and that is to the passive loss limitation. So first of all, let's define what a passive activity is. So a taxpayer does not materially participate on a regular, continuous, and substantial basis. And we'll talk a little bit about how to determine whether it's regular, continuous, and substantial. And most rental activities and limited partnerships are generally passive. So these are the tests I mentioned to determine whether you are materially participating in an activity. And if you meet any of the tests listed on the screen here, for example, you contribute more than 500 hours to the business, you are materially participating in that business. So this second test, the passive losses, are allowed only to the extent of the passive income. So it generally can, with an exception we'll talk about shortly, generally these passive losses can only offset any other passive income. So what are the kinds of income we're talking about? First of all, there's active income. That's like if you have a job and you're earning wage or salary. That's active income. Portfolio income is if, for example, you have investments and you're making money on those investments. That's a portfolio income. And then there's the third category of passive income and losses. Generally, these passive losses cannot offset any portfolio, or active income. Rental activities, as we talked about, is usually passive. If you're in the business, however, of renting a real estate, such as a real estate professional, then that's a Schedule C business and is not passive. There are other instances where real estate is not passive and they're listed in your text. So this is one exception, that there is a $25,000 loss allowed for rental activities, and this is against other, you can apply this against portfolio or active income, but certain conditions have to be met. One is that you have to actively participate in the rental of activities. Again, this is different than material participation, but you have to actively participate and then own at least 10% of the property to qualify for this $25,000 loss deduction that can be taken against other passive income. This benefit starts to phase out when AGI reaches $100,000 and it's eliminated $50,000 later when it reaches $150,000. So yes, passive losses are always allowed against passive income, assuming you've passed the at-risk rules test we talked about earlier. And then any suspended passive losses are permitted. So for example, if you have suspended passive losses from a previous year, you can deduct that against a passive income in the current year. And gifts and inheritances do not trigger the use of suspended losses. So you can't take suspended losses against any gifts you're reporting as income or inheritance because it's really not a transaction event. So the at-risk and passive activity loss rules are applied in conjunction with each other, but in a certain order, right? So first the at-risk rules are applied, and then if you pass those tests for applying a loss against passive income, then you have to pass the passive activity loss rules. I will be demonstrating some of these concepts because that's really the only way to really understand these more complex topics in the video for calculating some of the problems at the end of the chapter and solving some of the problems at the end of chapter 13. Now this last topic we'll talk about in this chapter is the alternative minimum tax. The alternative minimum tax really is designed to make sure that all taxpayers are paying their fair share. So it's like a parallel tax calculation system with this alongside the standard calculation system we have. And so if it's determined that a taxpayer is just not paying enough taxes relative to their income, then we recalculate their taxable income by using this AMT formula. So the alternative minimum tax is calculated by starting with your regular taxable income, which is calculated using the standard tax formula we've used in previous chapters. We'll add exemptions and the standard deduction in, and then we may add or subtract adjustment items. We'll add tax preference items. We'll deduct the AMT exemption amount, which can be phased out. And then once we determine the amount, we will multiply it by either 26 or 28%, less 3,756 for 2017. So we'll compare the tentative AMT to the regular tax, and if the tentative AMT is greater than the regular tax, then this is the alternative minimum tax. And again, the only way to really understand this rather complex formula is to run through some problems and demonstrate this calculation, which I'll be doing in the second video. Makes it a little bit bigger here. But we can talk a little bit about some of the adjustments that we would make to the regular taxable income. First of all, on the medical deduction side, we know that AGI floor increased, and this actually is a change to 10% in 2013. However, in 2017, late in 2017, after this textbook was published, the floor went back down to 7.5% of AGI. So for 2017, we would not have any medical AGI adjustment, since the floor is down to 7.5% now and not 10%. It was reduced again to 7.5%. Mortgage interest must be used only to build, buy, or improve residence. If it's not, then that interest deduction is taken away for AMTI purposes. Charity, there is no adjustment there, so you still get your full charitable deduction. No adjustment either to casualty or theft deductions you may have taken on Schedule A. And then miscellaneous are not allowed for AMT, alternative minimum tax purposes. So these are some of the adjustments that we would adjust our regular taxable income. So the calculations then for the alternative minimum tax is we continue to make, besides the itemized deduction changes, we could make changes to basis for gains and losses, incentive stock option adjustments, adjustments to K1s that we might receive, for example, from a partnership or an S Corp. And this K1 send down our portion of operating gains and losses, income, and any charitable contributions, for example, that the limited liability partnership, for example, might have made. So there will be maybe some changes made to those for AMT purposes, and then long-term contracts, there are some possible changes for those as well. Then we're allowed an exemption. So after we've made these changes, we're given an exemption, and these amounts, of course, are subject to change. But there is a phase out of these exemption amounts, and as I say in the problem I'll be going through, will apply some of the concepts of using the exemption amount to finally determine what our alternative minimum tax is.